Good afternoon, good morning, good early afternoon to some of you, good late afternoon to some of you joining us as well, including our guest today, Sean O'Neill. Hello to Sean, welcome. And thank you for joining today's inService podcast series segment. Really interesting discussion around unlocking OEM growth through aftermarket intelligence. I am so incredibly pleased to be joined by Sean O'Neill from Syncron. He's the Chief Product and Technology Officer. We're going to introduce Sean in just a moment. Let me get through the topic introduction and some housekeeping before we get things kicked off, and then we'll rifle through today's session here. I'll be joined in this role of moderation with my colleague Gerardo Pelayo, as normally. Gerardo is our VP of Research and Advisory. Thank you for joining, Gerardo, and looking forward to you moderating. So for those listening, we hear you, we see you, some of you on LinkedIn. So some of you have joined us through that means, so thank you. If you care to engage in the discussion, you can comment. It will come through, and Sean has agreed to think on his toes here and maybe even be responsive to some of those inbounds. So thank you, Sean, for your agreement to that. Today's podcast will be recorded. It's available on whatever podcast channel you subscribe to. You can find it at our website. You can find it on LinkedIn, and I'm sure it will be all over the place, including Syncron, our host partner for today's session. Without further ado, let's talk about the topic unlocking growth. So the last several years, we've witnessed kind of a roller coaster in terms of, this evolving mindset of the service leader. We've seen a shift from a cost and preservation mindset to a customer orientation to a growth and innovation mindset most recently. And, I was looking at the preliminary data from the Service Leaders Agenda survey we currently have in market. Hint, hint, if you're a service leader, please take that survey and contribute to the data. But there's a mindset shift that's landing in three areas right now. And this is only preliminary data, so this could change. But the top answer choice was service innovation with how service is delivered. The second is service operations with an orientation around process transformation. And then the third was this orientation around the expansion of the service portfolio and new paths to self-service. So, we've been advocating for service leaders to maintain this growth mindset so that they can find their way more prominently to the boardroom, so that service can be recognized more strategically as that profit lever that it should be. And, I got to tell you, one of the primary ways there is through parts and aftermarket. And so really excited to get into today's discussion. And along all those themes, those year-over-year themes that we've been signaling from the service leader, one of the things that we've seen consistently is service leaders turn their attention towards intelligence as the raw material and the building blocks to achieving all of the above, right? Whether it's technology investments or the removal of friction for both the customer and the employee, or future innovation and operational performance opportunities to improve. Innovation is being led by intelligence, data, and this oil or currency that is fueling this whole service economy here. So I'm really excited to get things kicked off. I'm going to bring Sean into the discussion. Sean, I'd love to, you probably have seen Sean around with his fedora. He is that fancy, classy guy that's always wearing a fedora. And Sean, we're so pleased to have you as a board member and for today's discussion. So thank you very much for joining us.
Well, thanks for having me.
Quick introduction.
Sure. So I'm Sean O'Neill. I'm the Chief Product and Technology Officer for Syncron. Joined just over a year ago, but I've had a long career through data and data-driven businesses around Amazon very early on, including inbound, outbound transportation, logistics, Tesco, one of the world's largest retailers, lots of data-driven businesses like GFK, which primarily serves the largest manufacturers of electronics and retailers. But through all of these, data and the information you can derive from it was key. It was the fuel to helping people make better decisions every day.
Outstanding, Sean. Well, a very warm welcome, and I will bring Gerardo into our discussion to lead us through our Q&A.
Thank you, John. And Sean, thank you for joining us first off. And as we're understanding your role, your scope, something that would be useful for the audience is to understand a little bit better how you engage with your customers in this service mindset. And in particular, one of the things where I see that there's often not enough clarity out there is on what the service lifecycle management mean. So if you can expand a little bit on that and how it ties to that aftermarket intelligence that both you and John have introduced.
Absolutely. And just as background for some of the audience, if those hopefully are already familiar with Syncron, but if you're not, we've been around for over 25 years. We serve some of the largest OEM brands on the planet, Caterpillar, Volkswagen, Volvo Construction, Ford, JCB, Daimler Trucks, and many, many more. And we solve problems around many different sectors, around their inventory and parts planning and supply chain, around the pricing of parts and service contracts and how to move from cost plus to value based, and field service and how to think about the technicians in the field, their knowledge, warranty, supplier recovery. But historically, we had treated those as three separate propositions. And the reality over the last few years we came to realize is they all work best in concert. There needs to be an orchestration. And in so many of our clients I've spoken with in the last year, they still are trapped in their own silos of their own construction. And they have data they come to us to use because they can't get at the exact same data that already sits in their own systems. They're trapped. But the service lifecycle management is an important concept because I have so many conversations with our customers about how do I drive loyalty and how do I drive engagement and how do I know if someone's going to buy another of my machines or vehicles the next time they need. And what I've realized is that all of these are questions of market share, aftermarket share. Somebody is servicing those vehicles and machines. Somebody is selling them the parts. Someone is doing the labor and the service on that. It just might not be you or your dealers. And so the real problem we're solving here is a loyalty problem that you can actually measure through market share of aftermarket. Now, the service lifecycle management, it's about how do all of these connect? Because so often I'll see an example where, one short example, somebody in a warranty claims processing adjudication process, they start to notice that a new vehicle that's out in the market has a lot of claims, so many claims, they actually have a defective part. And so they mark a part as defective through the warranty claim process, and they know what the replacement should be, but that information is trapped. It doesn't get to the parts planning team, who unknowingly about this, the next week they buy 100,000 units of the defective part. And without knowing that, the pricing team says, well, this replacement part, we don't have a whole lot of demand for it, but we're underpricing it. We should double it. And then the customer gets into the recall for this recall part, and they can't get their car fixed for a week because the parts aren't available. The price has doubled, and they're outraged at the brand. That's the last thing this brand wanted to do. And all of this is about the information silos. So to really drive it together, service lifecycle management that Syncron is driving is about linking the whole together with our data central platform as the key so that you actually can bring the information you need together to unlock joined up decisions.
Sean, you make some really great points there. I just want to react to something that really called out to me. According to our State of the Market supply chain survey last year, we asked the question, who owns service parts? And 1/3 of responses said that supply chain does. About 21% said that it was owned within the service function. And too often in large OEM manufacturers, we see ownership in those two threads, right? And there's the creation of a silo-like functional process across the service business as a result of that choice. So I think that's a really critical point you make. You know, whoever owns it is fine, right? But the integration of these two functional processes that touch across the aftermarket supply chain, it needs to be integrated in a fashion where these workflows come together and merge. So I think you're right on spot with your definitions here. So
I think there's building on that. Part of an organizational challenge of any big company is you're trying to measure benefits and outcomes from your functions and your teams. And some of the behavior you see, it's all based on the incentives. And if somebody is, if you can measure the inventory availability and you can measure the holding costs, you can hold a supply chain team accountable for how good are you at the right part, the right time with the right inventory holding costs. But if it's hard to measure market share of aftermarket, then you can't give them the incentive to improve it. So in many cases, it's not just a, do we have the visibility, but what are the incentives the organization is measuring their teams on?
Interesting.
That's a good point. And one of the things that also resonated with me was the importance of measuring that intelligence in a pragmatic way. You brought up the aftermarket share as a mechanism of the vehicle for creating that visibility. And one of the trends that John and I discussed earlier in the year in our first podcast for the top 10 predictions in service was this shift in the focus from the manufacturing world towards service, and many things driving that, from a slowdown in sales, a rise in product returns, the fact that there's higher margins in aftermarket. So all of that, we saw it as a brewing soup that is leading into these trends. I'm wondering, have you seen something similar, particularly for those OEMs with complex assets? And perhaps if you could illustrate how they're starting to think differently, change that focus through an example or not another use case.
Absolutely. And one of the interesting points is many of the clients we see in our industry, aftermarket has usually been managed as a totally separate business. And in the last few years, it's getting a lot more attention and care because companies are recognizing faster revenue growth and much higher margin than the original finished goods. So they're seeing that. But we should ask, where is that higher revenue growth coming from? It's actually a steal share of somebody else was serving those parts before, and the OEM is starting to capture some of that. It's a steal share approach. Now, this is where we can elevate the aftermarket from being an afterthought at the group level to being a savior. Recently talking with some of our clients where on their finished goods side, they've been missing the sales targets for the last few years. They're not selling enough new vehicles. Now, every vehicle sold has a cash flow stream. They can predict of what percentage of those vehicles in year +1 will we service with labor and parts through our dealer network, what in year 2 and year 3 and year 4. Well, what happens when they don't sell enough new vehicles? You've lost an entire cash flow stream. So this goal of how do you increase customer retention for these service opportunities is really a question of how do you increase market share of aftermarket that has a higher margin already and may even fill a gap of not enough finished goods sold. So in this point, for these aftermarket leaders, you not only are solving an aftermarket business problem, you're solving a group problem. And you've elevated yourself and your entire function to possibly be the savior for not selling enough new finished goods.
I just want to build on your comment of the profit opportunity in aftermarket. I think it was BMW. I was looking at the data on new cars shipped. They're seeing about 10 to 12 points of margin. On aftermarket parts, they're seeing somewhere between 50 and 65 points. So it is an incredible opportunity. I completely concur with your thoughts there.
And even some of the customers we're talking to, we have a new product we're bringing to market called contract price. And for a long time, we've been pricing parts, millions of parts and all the complexity. We make it easy so that you can do in a value-based way. And we're doing the same approach with contract price of how do you set the right service contracts and how do you forecast, take all this data in of all your service events from all your models, what's the historical cost of parts, and labor and inflation and transportation, and what's the forecast for them, and how do we extrapolate and build machine learning models for this. And what's valuable is not just what's your attach rate of a 2-year service contract, 3, 4, these extended warranties and beyond, but go back to my point of not selling enough new cars. When you have a service contract with a higher attach rate, you're locking in future aftermarket share. You're locking in the right to service the parts and the labor for those versus losing them to the market. So this is more than just, I wish we had a higher attach rate. You're actually keeping your repair bays full by having more service contracts. And so many of my customers I see, they have no idea which contracts are profitable or not because their tracking is terrible on these service contracts. They just see at the end of the year what's the overall P&L, but they couldn't tell you which model or which year or which dealer had set the price. Terrible on the quotations. There's a definite need here because the smarter you are in your contract pricing, you're not only increasing your overall margin, you're locking in future share. in years +1, 2, 3, 4. And that, again, can solve a group level problem. You can be the hero.
Absolutely. And I just want to build off of your comment that you made around steal share and the orientation of, the relationship between OEM and dealer network, which is a really interesting one, because the further you get from the asset, the more disconnected that dealer network becomes in terms of enablement, in terms of all the good things that are needed to maintain that brand equity, that brand experience. Talk a little bit more about that steal share comment that you made and that relationship between OEM and dealer.
Well, I think it's important to know, where does the growth come from? Because everybody knows that the aftermarket is growing faster than finished goods. And in some cases, it's because it's been ignored by the OEM. But the reality is cars aren't breaking at a faster rate. You're taking the share away from an independent service dealer. That's really what's happening here. And it's important to know, is this growth an organic, like in other markets, electronics or others, you can find an occasion of use. Put another TV in another room is organic growth, not steal share. But for the TV market, taking your living room spot, well, that's a steal share approach. Someone else already has that spot. You got to take it away from somebody else. And it's useful to know because you have a different strategy about why does somebody choose not to come back to your dealer network or your repair shops? You have to know why the end customer is choosing to not come back. Is it too expensive? Is it they feel like they get they came in for a oil change and they end up leaving with the transmission? Are they getting sticker shock? There's all sorts of challenges that could come into play here. And you need to understand why somebody chooses when they come to you and why other customers choose not to come back to you. And there's a lot of benchmarking of your best performing dealers or channels and your worst performing. Because and this is the value of, I've worked in retail and other channels for a long time. There's this fantastic concept called your fair share. What is your entitlement of what your best in class channel is doing, or dealers? And then how do you benchmark all your other dealers against that? And the gap is your fair share gap. Everyone wants their fair share. How do you then figure out what correlates with your best performing channels? Is it the labor costs? Maybe the labor cost is okay, but they take 3 times as long to do a repair that other shops do in a third of the time. Something is in there that is causing people to turn away, or you're just in a more competitive environment. But you need to focus in on how do you get those customers back. And the holistic data makes a difference. Your service event data, your warranty data, your supplier claims data, your break fix data, your parts inventory. Do you have the right part available? Do you have a technician who's skilled to do the job? What's the service wait time for it? How are you priced on it? This is the service lifecycle management. It's all bringing that data together so you can make a better, more informed decision to achieve your goal.
So that's really interesting. And by the way, I apologize. Part of one of the things that we normally have to fight back on this is uncertainty and resilience. So you'll see that I had to change locations because of a bad connection, but I'm back and eager to participate again in the conversation. So what you bring up about that customer data and customer intelligence is a critical point, I think, because one of the research efforts that we just wrapped up earlier in the year was our 2025 KPIs and metrics survey. And over there, more than 6 in 10 service leaders were saying that customer metrics are critical for them to drive decisions, to get executive influence. However, less than half of those same leaders considered the customer metrics amongst the easiest to consume. And the thing that I get out of that is there's a significant gap between customer data and customer intelligence. So how to actually arrive at information about the customer with the interactions, with the persona, their wants, their needs, their cans, and translate that into a strategy that makes sense, that helps support the growth. And I wonder, you spoke to many of these data sources that make up that raw material for intelligence. Are there any particularly significant ones that you've spotted, or the key data sources, data processes that organizations are missing in order to jump from that customer data towards customer intelligence?
It's an important question, and I think part of it comes down to one, a good profiling of your own customer base. And there's a fantastic concept called jobs to be done. Why does a customer buy your product or service when they could go to many other places? And you need to understand why. And there's a famous old quote of nobody needs a 1/4-inch drill, they need a 1/4-inch hole. They just happen to buy a drill bit as one of only a million possible ways they could get a 1/4-inch hole. And in some cases, customers could choose to just go without. If it's too complicated or too expensive, maybe they don't get their car serviced. Maybe they live with a dented door because they just feel it's too expensive or too much effort to get it fixed. So you really need to understand your customers and segment them in some way that you can act on it, because not all customers have the same value. You may have some customers who chose you because perhaps they bought a closeout lot of something, and they bought a machine or vehicle that you're not even supporting anymore, and they only bought it because it was a penny cheaper than another model. You're probably not going to drive a lifetime value with that customer, and it might take a lot of effort. But if you find the customers where your proposition, your reason to buy your product makes a huge difference for them, how do you grow your share there? So there's a lot of value of thinking about your customers, your segments, and your share. Now, many clients, they struggle to get the data. Some industry sectors are a little bit more advantaged, like automotive. They happen to have a lot of mobile apps that you want to control the dashboard, the entertainment system. Well, you download the app for Ford or for Nissan or for Volkswagen. And suddenly, even a second owner, third owner, fourth owner, the OEM actually has a connection and a relationship. And they can go back and forth. They could send messages about, yeah, you should bring your car in for repair or take a survey. So there's all sorts of ways they can engage. Not everybody is blessed with the luck of having a customer raise their hand by installing an app. But you got to do a proxy. And one of the things I've learned, and especially 25 years ago at Amazon, I had the luxury of billions of data points to help me make high quality, very informed decisions. But at times I was working on elements in the warehouse where we never tracked it. I didn't sit back and say, well, I guess we don't have the data. I'm just going to wait until somebody walks in the door with data. I got a clipboard and a stopwatch, and I walked the floor. And I would just track, and I would do a small sample. And yes, it was only 100 observations, but this is the power of Six Sigma and some of these other operational excellence processes. Get the data you can, because at times you'd be shocked at how little data you really need to make a better decision. Doesn't mean it's a perfect decision, but it helps you find a way forward, left, not right.
Yeah, no, that better concept, I think, is critical to move away from inertia, and better can be faster. It can be at a higher scale. Trust is a big component in there. And the connectedness between the data is another piece that I'd like to touch on. First, just building, you spoke about growth and revenue in particular. And I have mixed feelings about what I'm going to share next, because service parts revenue, when we looked at our service supply chain research, it made the top 3 in terms of metrics for the first time in the survey. And that was very encouraging. And we said, hey, great.
Yes. Can I just to clarify, what was the question it made the top 3? Importance or success, or what was, I don't know what the measure was.
Yes, it was what are the metrics that you're going to be most focused on during the next year for service supply chain leaders. And a long list of 10 plus metrics. Service parts revenue, the year before, it had ranked number 7, and that's usually where it lived. It went up all the way to number 3, which is encouraging. You said bigger agency amongst service supply chain professionals. However, and this is the part that is disappointing, even if not entirely surprising, in that KPIs and metrics survey, where we take the bigger picture, the bigger umbrella about the service organization, service supply chain metrics ranked 5th in importance, behind customer metrics, revenue and growth, cost and productivity, and employee metrics. And even if we went into that revenue piece, where we could argue for that, service parts revenue as an option there ranked at the very last of the list. So how do we reconcile this? and expand the importance, the understanding of service parts, going from defense to offense, if you will. And shameless invitation here, by the way. That's a topic that we find it so relevant. We're building an entire service journey day around that on March 4th at the Manitoba company. They're going to host that conversation to workshop how do we get through that transformation. But I'd love to get your viewpoints on that.
Well, so picking what metrics are most important, it makes a big difference. So what's the focus for an entire organization for some, usually a year? That's where a lot of people's annual goals and maybe even their entire bonus plan for the whole function or the leadership is based on. And I think it touches a bit on our talk earlier. How do you set the goals for a function? And it's hard to measure loyalty as a whole. So sometimes you end up getting a imperfect input to the goal, but that may not encourage other functions to even align or cooperate because they're so individually measured. Now, part of how I think about it is I always want to get as strategic and high up in the conversation as I can. What is the big outcome that a business is trying to do? And a lot of times it comes back to profitable growth with a loyal customer base and increased penetration of their total addressable market. This is the highest level. And for some of these, increased service revenue actually is an output. And some of the other ones, like supply chain metrics, well, you're probably not going to increase your parts revenue if you don't understand your supply chain and your misses and your availability and your costs. So to some degree, I'm less concerned about that because some of those are inputs that if you don't do that well, you're not going to get the outcome you care about. And I always prefer to talk about outcomes because most business ideas are flawed. Startling statement. Most business ideas in their first form are flawed, but nobody knows that until you try and implement it. I've lived this in the software world where every stakeholder exec comes and says, just build me an app. No matter what my problem is, build me an app because an app's got to be my solution. And it turns out it doesn't always make the difference because maybe there's something else. So I always want people to focus on the outcomes like service revenue, net promoter score, customer retention, some other loyalty metric. Margin is an important outcome here. Can we do this profitably? And then look at the inputs. And it turns out probably 90% of the work we're doing is waste of time and 10% of the effort provides all the value.
So let me double click. I want to double click on that last piece because the balance between customer loyalty and growth. In our research, for every leader that was focused on maintaining their performance around customer retention, there were 5 that were focused on growing that customer retention. And profit margin, for everyone that's looking to maintain 2024 performance, there's 3, a little bit over 3 that plan to grow it during 2025. So how to balance these two? Because it's easy to increase loyalty if you provide a better deal from a pricing perspective. How do we reconcile this simultaneous objectives that service leaders are after? So
in the aftermarket space, going back to this idea of steal share, these cars have a certain break rate. These vehicles have a certain maintenance rate. Someone's going to serve it. So new revenue for a dealer or an OEM is stolen share from someone else. But how does somebody else grow their business who's also trying to serve the market? They steal it from you. So you can't take for granted your existing customer base. Like it's your entitlement. You've already got their loyalty to some degree. Can you keep it? It's far easier to keep it than to go acquire a new customer and steal it from someone else. So any strategy has to be multi-tiered. It's not binary of you only try and retain or you only try and grow by stealing from someone else. You actually need to invest in retaining your base because that has the best return on your effort and your spend. You've already got the customer. They've already chosen to give you their business. How do you keep it? Separately, you got to figure out, and almost every company, the economic machine demands growth. We want more. Great, you did this year. Give us more. That seems to be a common challenge. So you need to have a strategy of what's your protect your share and your base strategy. And then you need a steal share strategy. How, because you should be entitled to those customers coming back to your dealers or your service shops. Why are they going elsewhere? What led them to choose to not bring their business to you? That's a conscious choice. It's not an accidental choice. And I think you need to have both strategies in place in order to build a healthy business.
Got it. And one possible lever to help with that could be warranty management. And I want to talk about that because, as I brought up inertia earlier, warranty management is perhaps one of those areas that has had a lot of stability over the years in how we think about it and approach it. And there's multiple things that are taking place that I feel could change that direction. There's right to repair legislation expanding in the U.S. There's multi-vendor competition that we see growing not just from within the industries, but also from adjacent industries that are looking to get some of that market share. There's new ways of thinking about what a service contract looks like, all the way into outcome-based situations. Are there any challenges or opportunities that you see for OEMs as they perhaps rethink what warranty management looks like?
Absolutely. And there's, you can think of it as now, next, later. There's the basics to protect the base. And warranties, as we know, super expensive. Just in the Service Council sessions last year, one of the keynote speakers talking about 2.5% of the new car and light truck prices of finished goods, 2.5% is spent in warranties. That is an incredible amount of money, given how there's pressure on new vehicle sales overall. And so a big piece of that is, one, making sure that you have a capable modern system that's going to help your teams make better, faster decisions. I see so many clients that are running their warranty programs on Excel, on some homegrown tool they built 20 years ago. It's not keeping up with their business or their needs. Because a big piece of this is not just, can you adjudicate a claim in a proper time? How do you use machine learning data like we use at Syncron to really get to a better claim recommendation, and even picking out soft abuse that we might see on what people are trying to book, how many hours it took. There's a lot of soft fraud throughout these. But more importantly is supplier recovery. That is an immediate way that you don't just take that 2.5% hit yourself, but you figure out through inspections in our other smart blocks, what was the causal parts there? It's not just the part that broke initially, but what was the causal part at the root, and who is the supplier or subcontractor of that? You're entitled to money back for that, and you should get that money. And this is a great way for a traditional cost center of warranties to figure out, how do we actually make sure that the burden is borne by the causal part suppliers.
I love it. Love it.
But where do you take this forward? Now, as you really think about warranties and you think about the service contracts, again, right to repair is an important topic, because you're on the hook for paying for it. And it's one thing to be paying for it through your own dealer. People have taken for granted that business during the warranty period would always come to their dealership, not with right to repair. You now have to compete for the customer's loyalty. So this whole concept of aftermarket share is more important now than ever, when you suddenly are open to competition, but you're still paying the bill for your competitor to steal the share, and you're on the hook for however many hours they're booking here. It's more important than ever to really make sure you have a fantastic dealer experience, that customers, when they're given choice, choose to come to you.
It's also more important why intelligence becomes the critical factor in understanding that customer relationship and commanding that customer relationship in terms of that loyalty, right? Because if you, the data is the key to the success in that relationship, as we can all appreciate. And I love your comment about serialized components and subcomponents and how much of a missed cost opportunity that is there. Because on these complex assets, there are so many contributing suppliers that recovery is just not happening, frankly.
That's right. You're leaving money on the table.
Massive opportunity.
Well, you're leaving money in someone else's pocket.
Exactly. Exactly. Yeah. I'm going to actually steal that steal share comment that you've been using.
You should. Well, this is the interesting part about, as I worked in many industries over my career, and at times some of the questions are so common. I hear from so many different clients we have, how do I increase the customer loyalty? How do I increase service retention opportunities? Another customer asking, when one of my tractors is sold, does that second or third owner choose to come to my dealers? Other customers are asking, hey, are my dealers buying some of the parts from third parties and not from me? Every one of these questions is a shared question. It is. And there's ways we can help you understand, frame, and track who's your best performing dealers and channel and who's got the greatest fair share gap. And then you can actually have a plan that's actionable. Where do you start?
Outstanding. Back to you, Gerardo.
Yeah, love it. And one of the things you just said is the recurrence of some of the questions and some of the topics. And one that's been very close to my heart in this whole space is that of forecast management and forecast accuracy. With dismay, again, in our 2024 service supply chain service parts management research, the most frequently identified reason for service parts challenges, and this was 63% of service executives, was the inability to predict demand with something other than historical data.
Yeah.
And we've had tools and processes that could help us in so much that could allow us to do this in a much better way than just looking at the past and making predictions based on that for years. And still, there's that lack of trust, that scar tissue perhaps, that has prevented this from happening, and perhaps even created a cynical approach to technology more in service supply chain than in other areas of the service space. So first off, before we tackle the behavioral aspect of it, how is it that everything we've been talking about, the connectedness between the warranty data, the customer intelligence, the service parts, how does this approach in practice increase the predictive accuracy in a way that matters to the business?
Yeah, it's so important because it's one thing to know what happened before, but what do I do tomorrow? And I love this old joke. Predictions are hard, especially when they're about the future. This is a difficult space. And I see too many customers who just look at last year's performance and say, well, I'll extrapolate it. But then you get something like a black swan event like COVID, where suddenly last year's performance is a terrible predictor of what's going to happen next. So at Syncron, we've been doing forecasts in supply chain and parts planning for over 25 years. And we passionately care about this. And the challenge about predictions for aftermarket is it's so different than your finished goods. You can't use supply demand curves and elasticity assumptions here because you've got 50 or 60 years of goods still working in the field, and you've got to figure out what parts are going to be needed when. And in most periods, it's a 0 or maybe a 1 of the number of parts out of the millions. That's a hard problem, and that's what we pride ourselves on. And in many cases, it's about using advanced probabilistic forecasting, which models both the customer needs, the customer arrival process, the order sizes, what is the minimum order quantity. There's all sorts of elements, transit time, that we use to help our clients manage that. But I like how you also talked about it's the service lifecycle management as well, because this forecast has so much value. And we have been doing it for decades in our parts planning side. We also have a lot of pricing customers who price all their parts. And in the price field, sometimes they're using last year's parts inventory to try and predict and forecast pricing for the next year. This is why we're linking these two things together, a native integration between the forecasts from the parts planning, totally aligned into the pricing team so that they have the same information, shared insight, understand even at a local level how much inventory is where when they want to run a promotion, so that they know, will the stock even be there in this region if I'm going to promote something? But this also goes even to the contract price product that I talked about before, of how do we help people even price their service contracts, extended warranties, 2 years, 3, 5 years, and what is the mix of that contract's proposition on break fix or preventative maintenance, different service levels. All that needs data. Data is the fuel that comes into our machine learning model so that we can help not only better understand which of your service contracts are dogs and which ones are winners, but even which ones are actually so profitable you've overpriced them and your attach rate's too low. because you actually you want a Goldilocks contract. You don't want anyone that's too extreme on either side, because you're going to regret either not getting enough business or losing money on these contracts.
And we're moving to quickly from this whole trend of personalization. We're leapfrogging personalization and going right to hyper personalization like right away, because the need to do all of the above dynamically, real time, not just using historical patterns, but dynamically in real time as customer behavior shifts. Right, yeah. There might be demand shifts on the customer side that signal a change in behavior in terms of maintenance, preventive maintenance, and how often they do certain things within that asset life cycle. So it is a horse of a different color as we move forward in terms of that dynamic environment that's being created.
Well, even you look around over the last 24 months, inventory shifts, inflation costs, you've got all sorts of commodity spikes. Suddenly your cost to serve's radically changed. Companies that used to reprice once a year for their aftermarket, that doesn't work. Recently, tariffs on products coming from Mexico into the US or Canada into the US. And suddenly people who thought they had a NAFTA supply chain and were protected with nearshore, now they're caught on the back foot. We need the ability for organizational agility. You've got to be able to respond, and not just respond across your 7 divisions and departments, but you want one steering wheel. When you make a strategic change, of course, how do you have everything lined up? Service lifecycle management. Even if your teams aren't talking every day, it's a good thing the tools are.
Strong message, Sean. Back to you, Gerardo.
And I really like how you took an integrated approach to this, because one of my pet peeves is forecast accuracy living in its own silo. Yeah. And particularly, you spoke about the zeros and ones the demand that happened over a 12-month period, an 18-month period. And still in those same organizations, I've come across forecast accuracy being reported, measured, and then the leaders penalized on a monthly basis. Yeah. And when you have zeros and ones, you're going to get it wrong 11 months a year. 12 for that matter, if you average it out as 0.08. So we need to, a bit of a word of advice, we need to be consistent in the metrics that we're using and what are we using them for, so that they're measuring actually the impact that we have. And what you brought in, the pricing, the design of the warranty, it starts to put together that picture. And I want to pull that thread a little bit further, because we often speak about predictive and proactive in the same message. And as I say it, we want to be proactive because we feel more confident about what's going to happen next, meaning our predictive accuracy has gone up, and therefore we trigger new things with a higher probability of success. Are there any best practices, any recurrent use cases that you're seeing for how these OEMs are leveraging the higher accuracy in their predictability, this better rounded aftermarket intelligence, to grow their market share, whether it's on how they price, how they, you spoke about running promotions. Is this something where you're seeing accelerated focus out there?
We definitely are. And we're seeing more synergies across the different functions. So parts planning into price is a natural one, because you're pricing the parts, you're doing the parts planning. And in many customers, we tell them in our tool, how many millions of dollars of excess stock or obsolete stock do you have based on the demand that's actually been coming through? And we tell them at a granular location, this dealer has too much of this part. But historically, that's been hard for the parts pricing team to actually know, so they can't actually act on it. And through these native linkages, the pricing teams now have visibility to all of the parts planning, the inventory levels, the excess, the obsolete, so that they actually can run liquidation campaigns while sending a message to the supply chain system, non-recurring demand, because a naive ordering system would say, hey, look at all these 1952 gears we're selling. We should buy 10,000 more. And suddenly they show up at the warehouse. That would be a naive system. So it's important to know they're linked up. But unlocking some of the information, like another use case I'm super excited about for us, is our pricing app has margin at a part level, but the parts planning team doesn't know it. And they're trying to make safety stock decisions of how many of each part should I stock. And as I mentioned, in many periods, 0 demand versus 1. How do I plan this? Well, as we link these together and bring the margin from the pricing tool into the parts planning tool, you can make a much more informed safety stock decision. How many units should I risk in this location? Now, if it's a high margin product, say it's got a 50% margin, even if I only sell through half of my units, I will have paid for the inventory holding costs from it, and I will have turned the inventory costs completely. But if it's a very low margin item, I might actually be locking up a lot of cash in these parts. And if they don't move, I'm stuck. So we're finding all sorts of ways working with our customers about how do we bring together the siloed information to suddenly make more joined up collective service lifecycle decisions.
I love it. And there's also an element here, Sean, of signaling that data back to the earlier journey in the asset lifecycle, right? Where service lifecycle becomes integrated with asset lifecycle all the way back to design for serviceability and supportability and future introduction of product. So interesting points you make here. Real interesting.
Well, and exactly, as you think about going back upstream to the finished goods, we're super interested in servitization and equipment as a service as a proxy label for it. Many of our customers, they're experimenting and testing of how do I get closer to the end customer? How do I do that in a channel way that doesn't alienate my own dealer network, which is very important, not a simple problem to solve. But there's value in figuring out how do you increase your lock-in of aftermarket share because you're charging a higher overall amount for a better level of service and runtime and uptime of the equipment. And this is also where a contract price product is so fascinating because starting with some basic service contracts, the modules evolve over time to really help our customers test in a low risk way, in a narrow slice, how do I figure out what is ultimately a new business model? And how do I think about getting closer to the end customer?
So as we're nearing the end, one of the things that I'd like to touch on is how to combat the sources of resistance that we see towards this change. We've talked a lot about why we should move in this direction, but perhaps the one that I hear most often, and we see it in the data as well, is even if I get great recommendations and I act on them, then I have no way of closing that loop at scale. And therefore, the new actions that I took are going to send misleading signals back into my data foundation, back into how I do the planning, and it's going to break everything. In short, it's going to break everything in the middle term. What are the best practices that organizations need to do to systematically prevent this and to build that trust within their teams?
So change management is always an important part of adopting any new tool or methodology. And don't underestimate the emotional side of what does this mean for somebody's job, who's doing it. I think back there's this great story in the past where factories in the 1900s started to be electrified. They used to be powered by steam engines. And then they popped in electric generators in the factories and they saw almost no benefit. They didn't see any benefit because they hadn't changed the way the factory worked. All the equipment and material flow and layout was the same of the steam engine, which meant the things needing the most power were closest to the steam engine. But a finished good might go through 5 floors of a building before it was complete. And it wasn't until 30 to 50 years after the electric motor was introduced that people figured out factory physics, started to rearrange factory flows, and you ended up getting small unit cells so that the complete production of a finished good only took a small loop and productivity skyrocketed. Let's now think about artificial intelligence, machine learning, generative AI. Everyone's clearly excited. When board members are asking, do you have AI in your product without even knowing what it does, it tells you it's a thing. Now, we have to think about how do we help solve the right problem, because we always take the new technology and we use it to solve yesterday's work. And only later do we figure out how the new technology can unlock an entirely new way of working. And that change management is scary to people, because it might mean we need different skill sets. It might mean we don't need 100 people doing this job. We need 5 people doing this job. It might mean we don't need that job at all. And don't underestimate the resistance you'll get, where people might be saying, well, what does this mean for me? So making sure that, now I'm a firm believer that AI and ML is only going to be as effective as the people who are directing it. We still need that expert. We still need that clear business input into it. We need the guardrails around how we will run this, but it is going to change the way we work. And we have to face into that with people of how do we make sure that we've got the right goals, we got the right alignment to what the overall company is trying to accomplish, and we have the right measurements of, are we on track?
And in a service world, right, we need to understand what role does AI play in a people first culture, right? Because we appreciate the importance of people in maintaining some of these complex assets. The field service is going to be a big element and a big channel of service, and that's not going away. We need to figure out, how does AI supplement, streamline, augment, and partner with this humanized automation, right? How do we create this marrying together of human and functional and technical roadmaps, if you will? So,
and in so many cases, a lot of our clients they struggle with talent retention. They have not just talent retention, but they have retirement risk. People are retiring and there aren't enough new technicians always coming into their field. Yeah. So part of the power that I see for technician enablement and knowledge bases, and what we're working on at Syncron, is how do we put more generative AI tech assist in, so that in your business, you should be able to take a good general purpose mechanic or a pricing employee who really understands your business. Maybe they're not a world leading expert in pricing, but how does our tool help them make decisions like one? Because you're not going to be able to hire the exact same number of master mechanics you've had in the past. They're not coming into the industry fast enough. And you don't want your business to live or die based on your retention of somebody staying in the seat or walking out the door. Yeah. We need to be able to figure out, how do we leverage these tools so that a good generalist who understands your business can make decisions like a pro.
Yeah. And I'll reiterate that message with some of the data. Technology has a huge potential, an untapped potential, by the way, of improving the frontline experience. We see in both our voice of the contact center agent as well as our voice of the field service engineer that about half of, so it's 57% for field service engineers, less than half for remote support, that agree that technology and incremental data have made their day-to-day work less stressful. That shouldn't be the case. There's a huge opportunity for leveraging technology, for leveraging that aftermarket intelligence to evolve from a data perspective into an enabler of their job and their mental health. So I think that's a great point, as so many organizations are fighting this talent crisis and retention and attraction, as you rightly call out.
And Gerardo, that relationship between human and technology at the front line has been improving, right? It was worse in previous years. And I think, part of why it was worse was because Frontline's voice wasn't heard in all these innovation opportunities. And, I think modern day service leaders need to consider part of the message to attract talent to the industry is part of the coolness of the technology enablement that they're building into their service enterprise, right? That these are cool technologies. Mm-hmm. It's a fun job. It's an important job. It's a lucrative job. And so, involvement of the frontline in that innovation process has served the purpose of improving that relationship. And it's a big part of it, I think.
Indeed. And we do see that that higher appetite for the more advanced technologies that is growing amongst the frontline. So capabilities that they don't have today, but consider as likely very useful in their day-to-day, that's there. We just have to figure out how to connect two and two together. I've also loved the historical references, Sean, and learning from the past, even if not the whole thing. It's always a useful, valuable, and fun. Are there any other gotcha moments, best practices that you'd like to share before we wrap up?
I really think it comes to two levels. One is sometimes the answers to your problems are inside your own data stores. You just don't know it. And people really need to invest in making sure that they inventory, clean, and document their own data. Not just point to a box, a server that's got it, but what does it represent? Do we trust it? Was it a one-time copy someone made? Was it a beta version? Because one of the biggest challenges of companies who want to be data-driven is that they're surrounded by data. They don't know which one to trust. And it's worth investing in that because garbage in, garbage out.
Great points, Sean. Hey, listen, for our audience, we've gotten to know you on the business side of things. Maybe something personal about yourself. I think there's something pretty hanging on the wall. Maybe that's part of something personal for you, but maybe something you could share with our audience about yourself outside of work.
Well, as a hobby outside of work, I am a painter and sculptor. And over the last 20 years, I've been painting all sorts of acrylic and sculpting metal and bronze. And it's working in software for 25 years. There's a lot of binary. It either deterministically works or it doesn't. And it's nice to have a creative outlet where I'm the only one who knows what it was supposed to look like. And if it looks funky, I'll say it was an artistic choice.
Outstanding. And who was the inspiration for the fedora, please? Because I've seen this as a common, every time I bump into you at an industry conference or our conference, the Smarter Services Symposium, mark your calendars, September 8th through the 10th, shameless plug. What's the inspiration on the fedora?
Well, long ago, I got into a fight with my barber and I lost.
I love it. I love it.
And so it's, just a fun thing I do that I like hats.
I love it. I love it. Well, it brings life to the service industry. You're making service cool. So he's Sean O'Neill. He's the Chief Product and Technology Officer of Syncron. This was a really chock full of insight and data for our audience. Sean, thank you so much for joining today. To our listening audience, today's podcast is recorded. You can visit back to it, go to our website, go to LinkedIn, wherever you subscribe to, you can get the audio version of this. We'll see you on the next episode. Sean, thank you so much. This was a great discussion. We'll see you on the next one.
All right. Thank you both. Wonderful conversation.